$1.7 trillion gone. Did Japan just end the reign of the US dollar? In just 3 weeks, $5 trillion vanished. US bonds were sold off. The dollar fell. And the country behind it all was Japan, what caused a trusted ally of more than 70 years to become the catalyst for a global financial disruption. It was a quiet but powerful financial move. For decades, Japan steadily invested in the US financial system. It held trillions in US Treasury bonds, helping the US borrow at low costs, supporting the dollar's credibility, and keeping markets stable. But in one night, Tokyo changed direction. $1.7 trillion in US Treasuries was released into the market. Bond yields surged. The dollar declined. Stocks dropped. To the financial world, it looked like a panic sell-off. To Japan, it was a deliberate response. Why? Because US tariffs were aimed directly at electric vehicles, including Toyota, Nissan, and Honda. Major Japanese companies were grouped with so-called foreign threats. There were no negotiations. No warnings. Just a quiet action that shook global markets. As the US faced the consequences, the ripple effect started. In 3 weeks, Wall Street lost over $5 trillion in value. Rising bond yields dragged down the stock market, but the biggest impact wasn't felt on Wall Street, it was felt on Main Street. Car prices rose. Imported electric vehicles disappeared. Inflation returned. As the dollar weakened, the cost of imports, gas, food, electronics, increased. Everyday Americans, once promised that tariffs would protect their jobs, now saw rising bills. Mortgage rates climbed, shutting out potential homebuyers. Savings and retirement funds lost value, and the most troubling part, it wasn't accidental. This was the outcome of an unchecked economic approach that traded long-term stability for short-term political gain. Japan sparks a global shift away from the dollar. Japan's decision wasn't just about selling bonds. It was a message. The dollar was no longer the default. Soon after, other major economies followed. China continued reducing dollar reserves and increasing yuan-based trade. Russia had already moved away from US assets. India, South Korea, Brazil, and the UAE also started diversifying their reserves and expanding currency swap deals. Then Tokyo made an even bigger move, redirecting capital to Asia, purchasing regional bonds, strengthening currency cooperation, and reducing reliance on US dollar transactions. A new financial system was taking shape, one where the US dollar was no longer the center. A new global reserve currency was being discussed, led by an Asia-Eurasia alliance, with Japan at the forefront. The cost of overconfidence. Why didn't Washington see it coming? It assumed Japan would never push back. Since World War II, Japan had been a loyal ally, financially reliant on the US military through alliance treaties. Washington believed it had full control. As US markets fell into disorder, other nations took notice. One by one, from Asia to Europe to Canada, countries began to ask, is it time to move away from the dollar? $1.7 trillion was pulled. $5 trillion disappeared from markets, and for the first time in 80 years, America's closest ally struck at the core of its economy. April 2025. While Washington was focused on domestic stimulus efforts, Tokyo acted. $1.7 trillion in US Treasuries, once seen as strategic assets, was sold off in 48 hours. No press briefing. No discussion. Just one data update quietly posted on Bloomberg that morning. Wall Street saw the numbers and began to fall. It was the largest capital withdrawal in US-Japan history, and it made one thing clear. Financial loyalty is not permanent. Though weapons were used, just one massive bond sale, Wall Street reacted with sharp losses. The Dow Jones dropped 4,800 points. The Nasdaq fell by 12%, the S&P 500 sank. Worst levels since the 2008 crisis. Panic spread faster than any recovery tool. $5 trillion in US market cap disappeared. Bond yields on the 10-year Treasury surged to 6.2%. Homebuyers were crushed. Businesses were pressured. Credit card debt became overwhelming. According to Fidelity, 47 million retirement accounts were affected. Major pension funds lost 15 to 20% in just 3 weeks. Personal assets collapsed. Market trust was broken. The middle-class dream was torn apart. Wall Street didn't need a war, just a loss of confidence. And then the collapse began. After selling $1.7 trillion in treasuries, Japan didn't retreat. They shifted strategies, investing $300 billion into Chinese and Indian bonds, and $200 billion into Southeast Asian infrastructure. Reserves in yuan and rupees rose by 40%. US dollar holdings dropped from 54% to 35%. This wasn't a tantrum, it was a strategic move years in the making. The US wasn't caught off guard. Japan had given warnings: stop taxing our EVs, stop manipulating the yen, stop treating us like a junior partner. Washington didn't respond. So Tokyo acted: no threats, no sanctions, just stopped buying US debt and started investing elsewhere. As a result, the US lost its buyer, its leverage, and its leadership position. China had already reduced its US bond holdings from $1.1 trillion to under $800 billion over 5 years. Europe was focused on its own issues. The Middle East started trading oil in yuan. When Japan stepped back, America saw there was no one else standing behind them. And the system started to break down, bit by bit. No trade war. No official announcement. No social media posts. Asia didn't declare an exit from the dollar, they just changed course. In private meetings, Japan, China, South Korea, and ASEAN launched a new financial network. No ideology, just numbers: $1.2 trillion in regional currency swaps. Cross-border trade moved away from the US dollar. Bilateral deals were settled in local currencies. By the end of Q1, 62% of trade between Japan and China no longer used the dollar. The yen and yuan surged in global payment systems. No speeches, no drama, they simply stopped using it. And when the majority stops, the dollar is left behind. No weapons, no noise, just a quiet shift of trust. The old system began to fall apart on its own. At the G20 summit, a single document was passed around. Thin as rice paper, but more impactful than any sanction: a proposal for a new global reserve basket. The dollar wasn't included. No more exclusive control. No more Federal Reserve setting global interest rates. The new basket included gold, energy, defense, tech, and Asian and European sovereign bonds. According to the IMF, the dollar's share of global reserves dropped to 52.7%, its lowest in nearly 30 years. The yuan and yen gained more rapidly than at any time since becoming globally recognized. No one is rejecting America, countries are simply choosing a different path, one where they don't need permission to use their own money. This isn't a collapse. It's a shift. The dollar wasn't defeated, it was just moved aside. Then, in one night, the stock market surged thousands of points after Trump announced a tariff delay. But was this strategy or just a classic pump and dump? Just the day before, Trump had stated clearly that he would never delay tariffs. Yet, suddenly, he changed course, announcing a 90-day delay. During this period, reciprocal tariffs would also be paused as negotiations continued. The stock market immediately jumped, gaining thousands of points in one day. Major investors and Trump-connected billionaires made large profits instantly. But what really happened behind the scenes? Before the public announcement, there were suspicious trades, large purchases of stocks and options just ahead of the news. Once the decision was revealed, profits from these trades soared by 2,100% in just 1 hour. Were these trades influenced by leaked insider information? Or did individuals with close ties to the Trump administration take advantage of the policy shift for personal gain? This is Charles Schwab is not just a company, it's actually an individual. He made $2.5 million today and $900 million overall, as he is financially involved behind the decision to delay tariffs. There are unexpected calculations at play. Who really benefits? Big investors. Billionaires in the financial world are the first to gain from these decisions. Major players like investment funds and multinational corporations made huge profits after Trump announced the tariff delay, when Trump makes sudden changes, big investors are able to profit immediately. Work with us on the negotiations, he says. We have a lot of law firms that have paid me a lot of money in legal fees. We're probably going to use those firms, if we can. I think we can. I'll make a contribution to the country. But they're great firms. They're the best, the biggest, and the most prestigious. Yet these groups don't face the same risks as workers, small businesses, and entrepreneurs who are struggling. While Trump's policies might bring short-term benefits to the market and large corporations, the American people are left to deal with the long-term consequences. Small businesses and everyday workers will bear the brunt. As these policies create economic instability, the stock market might go up and down, but workers and low-income American families will face inflation, rising living costs, and job instability. So does Trump's policy really benefit the American people, or does it mostly help those who already have power and money? With inconsistent decisions and sudden changes, people are losing faith in Trump's leadership. His policies might cause short-term disruption, but what about the long term? Does the Trump administration truly care about the people, or are they mainly working to keep power for themselves and their business allies? When the tariff delay was announced, America's allies like Canada and the EU responded strongly. However, instead of continuing to oppose Trump, they quietly accepted the new terms and resumed negotiations with the U.S. under the new conditions. Canada, which had once promised to retaliate against the increased U.S. tariffs, stayed silent and agreed to continue negotiations when Trump delayed the tariffs. Meanwhile, the European Union, which had strongly opposed Trump's tariff policies, had no choice but to accept the new terms. After Trump announced the delay, the EU quickly agreed to a zero tariff for zero tariff deal. Nonetheless, we stand ready to negotiate with the United States. We have offered zero tariffs for industrial goods, as we've done with many other trading partners, they said. Whether this was a strategic move or not, the decision shifted the market and had significant consequences for the American people. $2.6 billion. That's how much China spent in 2023 alone on lithography equipment from ASML. Now, all of that has been lost. A tech shakeup is already beginning. No more ASML. No more TSMC. In their place, a firm message from Beijing: we'll do it ourselves, and we'll do it better. China is now considering fully ending its technical and trade relations with two tech giants, ASML from the Netherlands and TSMC from Taiwan. But this is not a typical farewell, it's a permanent one. What triggered it? The United States applied pressure, leading the Dutch government to revoke export licenses for DUV machines, a critical technology for producing advanced chips. $15 billion worth of machinery already in China became unusable. No maintenance, no updates, no support. A complete break. And China responded firmly. This wasn't a sudden reaction. As early as 2022, China began quietly restructuring its domestic semiconductor industry. They invested over $75 billion through state-backed funds focused on key areas like chip design, wafer production, and lithography, but it wasn't just money. China also brought in over 50,000 engineers, many from Huawei, SMIC, and even some returning from Silicon Valley. In just 3 years, China achieved what many believed would take a decade, building a nearly self-sufficient chip supply chain. Factories are now running with 60 to 70% China-made equipment, and local labs are developing both chips and design software within the country. China is no longer playing catch-up. They're beginning to change the rules of the game. The biggest surprise? China says it doesn't need EUV, the $200 million machines from ASML once seen as the most advanced technology in chipmaking. Instead, a company in Shenzhen called Sakar claims to have developed its own DUV lithography technology capable of producing chips smaller than 7 nanometers. Just remember the Huawei Mate 60 Pro.